Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, some weeks when I do this show, it can feel like not much has happened since the previous episode. And you get periods where the market movements and associated narratives become fairly rigid. But then you get weeks like this week where I almost don't know where to start, to be honest. There's almost too much to cover in a 10-minute show, but not only that, things are moving at such a pace that any insights or commentary that I provide almost immediately tomorrow's chip paper. But anyway, I'll give it a go. So, part of the fun of following investment markets is that constantly changing narratives and backdrop. So, as a quick reminder of where markets were this time last week, the German DAX and European equities more generally had surged from recent lows in a rally that was inspired by hope of monetary and fiscal stimulus in the Eurozone, as well as a de-escalation of the war in Ukraine. Now, bonds had continued to behave like risk assets, with the yield on the 10-year US Treasury jumping to 1.955%, and gold was surging as it hit a new high of $2,078 an ounce. And meanwhile, commodities had just enjoyed the sharpest weekly rally in 50 years, with the price of a barrel of Brent crude touching $139. And in fact, the title of last week's show was History in the Making, and that, in fairness, could have been the title for this week's show. So to start off, I'm going to start in Asia, and in particular with Chinese equities, which have been in the grip of a sell-off that sparked memories of the financial crisis in 2008. And in fact, on Monday this week, the Hang Seng Chinese Enterprise Index of mainland Chinese stocks fell over 7%, which is the most since the financial crisis. And not only that, then on Tuesday they fell another 5%, which brought the year-to-date losses down to 25%. Now, if you focus on Chinese stocks, they fared even worse, with Alibaba share price being down 38% for the year, up to and including Wednesday. And traders were nursing huge losses with no respite in sight. Now, the cause of the carnage was a combination of factors. Firstly, continued stress in the Chinese property market, but also an ongoing regulatory crackdown on Chinese tech companies, plus the threat of sanctions by the US as punishment for Chinese apparent support of Russia's invasion of Ukraine, plus rising COVID cases. Now, the latter even caused the Chinese authorities to announce a 6-day lockdown in Shenzhen, impacting over 17 million people, with further lockdowns across China possible. And now, with no glimmer of hope on the horizon for investors, the Chinese authorities stepped in to reassure them by promising economic stimulus as well as measures to help prop up the market. Now, if you thought that last week's moves in the DAX were crazy, they have nothing on what was witnessed in Chinese equity markets this week following that announcement. Now, the Hang Seng Tech Index leapt 22%, the biggest daily move since October 2008. And it feels like we keep drawing these comparisons to the financial crisis, and that is a little disconcerting even when we are talking about positives. Now, the share price of Alibaba, which I mentioned earlier, leapt 27.3% on the day. Now, these are mind-boggling moves, yet we still await full details of what the promised interventions actually are, and there is a feeling that authorities are just making this stuff up. Now, while talking of interventions, it seems a natural segue to talk about central bank policy decisions. Now, first up was the European Central Bank, which I'll call the ECB, which they announced the latest policy decision just after last week's show, if you remember. And the ECB ultimately surprised the market by announcing it was bringing forward its plans to curtail the monetary stimulus measures it had put in place since the pandemic, which means reducing its bond buying scheme from April through to June, with the possibility that it may stop adding to its bond portfolio by the third quarter of this year. Now, this could mean it is more likely to increase interest rates by the end of the year, as the ECB desperately tries to keep a lid on inflation. And to be clear, this was a more hawkish announcement than expected from the ECB, which has traditionally been one of the most dovish of major central banks. Now, bond and equity markets in Europe recoiled from the news, albeit very temporarily. Now, if you judge the European market through the DAX, then the response to what's been announced, and despite that hawkish ECB announcement, it is now up 13% from its recent lows, which has brought the losses year to date to closer to 11%. Now, a significant tailwind that's actually helped that in the last week has been the tumble in the price of oil back below $100 a barrel. Now, that is an almost 30% fall in the price of Brent crude as traders hope for an improved supply outlook following positive statements around Ukraine and Russian peace talks. But in addition to that, the potential for the COVID-19 induced shutdowns in China actually sparked concerns that the Chinese economy may go into a downturn, and it would also cause a drop in the demand for commodities. So commodity prices started to fall more widely. And as commodity prices began to fall, equity markets began to rally. And even the price of gold plummeted over 7% back towards that $1,900 per ounce level, while energy stocks lagged the wider market. So energy stocks, commodities and gold had risen so far and so fast, especially after the invasion of Ukraine, that they had almost become the consensus trade, despite earlier in the year they'd been shunned. So some kind of pullback was almost inevitable. Now, in the last 24 hours, we've seen the US Federal Reserve and the Bank of England both raise interest rates by 0.25%. The Fed even went as far as acknowledging that a further 6 to 7 interest rate hikes are likely this year, matching what the market had started to price in. Now, this was a hawkish statement, yet after the Fed chair, Jerome Powell, painted a positive picture of a booming US economy that can withstand such monetary tightening, US stocks actually rallied into the close. Now, this is despite the economic uncertainty caused by rising energy and commodity prices following that invasion of Ukraine. But even the Bank of England warned of this inflationary spike, and it might hit 8% in the coming months in the UK. So you may have thought that equity markets might have taken a bit of a hit, or at least a breather after the Fed's decision, but no, they didn't. So interestingly, last week I discussed the positive technical signs we are seeing in the S&P 500, and they continue to be present, giving hope that the short-term bottom in equity markets may now be in, excepting, of course, any further escalation in Ukraine. Certainly, risk assets are enjoying a rebound, but there's still a lot to be done technically to safely consign this correction to history. Now, while narratives continue to change by the hour, one consistent theme has been for higher bond yields, and the 10-year US Treasury yield hit 2.2% in the aftermath of that Fed policy decision. In fact, bond markets are sending out a bit of a different message than equity markets after that Fed decision. Now, while it seems to be agreed on the fact that inflation is going to lead to higher interest rates, is also starting to suggest that the Fed's policy tightening might be a mistake and lead to a US recession. And when the US sneezes, the rest of the world tends to catch a cold. That's why it's so important. Now, you can tell these recessionary signs or hints through the early indications of a yield inversion on US treasuries. So something I've spoken about in the past is something to keep an eye on. Ironically, the bond market is even hinting that the Fed will be forced to cut rates again in the future to support the economy. And now this may be something that equity markets are looking at and are focusing on. So bad news, i.e. rate hikes, is actually good news, future rate cuts. Now that might seem a bit crazy, but that's essentially what equity investors have been doing for much of the post-financial crisis era. Ultimately, right now, there is a sense that investors, analysts, and central bankers are making it all up as they go along. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com, Twitter, money2themasses with the number 2. You can contact me via Instagram, Facebook, TikTok, and of course, don't forget to subscribe to our YouTube channel.